Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Jared Blikre, your host, and with me is Yahoo Finance senior reporter Allie Canal, who's here to connect the dots and to be that bridge between Wall Street and Main Street. Today, we've got a Wall Street money manager in the lineup, and we're going to look at the AI and tech trade along with the comeback kid this quarter, that would be healthcare stocks, and we're going to throw in some mobility and aerospace and defense picks for good measure. Our word of the day is monopoly. Not just a board game, it's the ultimate expression of a business moat. And our guest addresses this kind of domination for a living, so we will dig into it. And today's market show and tell is all about operating leverage. How do we find the companies that are best able to turn new sales into higher profits and higher stock prices? We tackle that with Uber as our guinea pig. And this episode is brought to you by the number 4.4%. That's the U.S. unemployment rate, a four-year high, but quite a bit lower than the pre-pandemic average. Can record fiscal deficits keep the U.S. economy out of recession in 2026? And today we are welcoming David Miller, who is the co-founder, chief investment officer, and senior portfolio manager at Catalyst Funds and Rational Funds, where he runs strategies built around insider buying and dominant high-moat businesses. Think monopolies. He manages the Catalyst Insider Buying Fund, which targets large-cap companies with significant insider purchases. He also oversees a broader lineup of alternative mutual funds and ETFs across the Catalyst and affiliated strategy shares platforms. So, David, I don't want to get too far ahead of ourselves here, but it's only a month left until the end of the year. People were discounting the ability of stocks to outperform the averages, and here we are, S&P up 15%. What do you think?
I think we've had a pretty good year. You look at earnings, they've been quite strong. You have unemployment numbers, they're pretty low. And you have a Fed that looks to be accommodative. So I think the stock market doing well in this environment makes a lot of sense.
And Ellie?
Are there any risks that you see? Because we've been hearing about a lot of optimism heading into 2026. We keep getting moves higher for S&P 500 targets, up as high as 8,000 right now, with Deutsche Bank calling that. So when there's so much optimism for the year ahead, are there any pockets that you're watching that maybe we should take a step back?
I think the main risk you have to the market is that the Fed doesn't go ahead with a rate cut. Because whenever you have an environment where you get bad news, and that means the Fed's going to be even more accommodative, that's actually probably a net positive for the stock market going forward, because that denominator effect, when you move that number, that makes a really big difference to stock prices. The really big problem you have is when you run into a 2022 where inflation gets hot, and the Fed has to do something to get that inflation under control, and hiking interest rates in a big way is the real kryptonite for the stock market.
Yeah, nobody's talking about hiking just yet.
No one's hiking just yet. We'll find out next week what the Fed decides to do. But it's time now for our word of the day, monopoly. It's when one company controls a market, faces little real competition, and can pretty much set prices how it wants. And there's a close cousin to that, the oligopoly, where a few big players dominate an industry instead of just one. Competition still exists, but it's limited and the power is concentrated. And David, you're actually connected to a fund called the Monopoly ETF, ticker MPLY.
Love that.
So tell us what monopoly means to you as a money manager.
Sure. Well, I think everybody's familiar with the concept of monopoly from playing the board game.
The guy in the top hat, yeah, we got it.
And as a goal, when you're running a business, it's pretty hard to beat a company that has a monopoly, because when there's no one else who can really deliver that product or service in the same way that you can get incredible margins. Even if you have a bit of a downturn in the market, you can still have really strong profitability. So what we recognized when we did a lot of research at strategy shares, and we partnered up with a group called Rareview about running and launching this monopoly ETF, is that if you just excluded all those companies from the S&P 500 that weren't monopolies and were companies like airlines, things where you'd be in pure perfect competition, or industrial companies, shipping companies, they didn't do nearly as well as those companies that have historically been the biggest winners that really dominate a category, like an Nvidia or a Microsoft or a Google. They're just so much better businesses.
I'm glad you just said Google, because that was going to be my next question. Google just, Alphabet in particular, its parent company, won an antitrust case that was kind of looming over its head. And I think a lot of that was kind of baked into the price, and maybe it wasn't because it's rallied significantly since then. That's also in consideration of Gemini really just cleaning open AI's product, ChatGPT, their clock. But how does a company like Google, do you think, which really came about via market forces, it's not like they had some government license, how do they hold on to that over time? And then how do you see that dynamic changing?
Sure. So AI is certainly changing that dynamic, but you could also argue at the same time that it looks like Google might be actually winning the AI game. Their new models are really dominant. They have a phenomenal business with search. There's no better business out there than search. Pure 100% type margins when you're just putting a search result out there, get paid for the click. Total cash flowing business and continuing to grow at double digits. And then you look at what they're doing in the cloud. They're growing in the cloud as well. You look at their YouTube business, also a double-digit consistent grower. There's no real alternative to a YouTube in the video space that's nearly as dominant. So it's really a company that's firing on all cylinders.
You mentioned Nvidia and how it sort of has this monopolistic nature within the chip space. But I'm curious your perspective because the AI chip space in particular is so nuanced to me. You have the hardware, you have the processors, you have the designers. Can there be a monopoly here? And is that Nvidia?
Well, when you think about what a chip used to be, you used to think of it as a much smaller thing that wasn't today what like you'd have as an
Now it has its own
or
radiator.
Blackwell. Yeah, it's incredibly difficult to replicate like what a Blackwell would be for another company. Are companies like an AMD or an Intel that type of chip a monopoly? No, for sure not. And all the hyperscalers are also trying to develop their own chips, but at least for the next several years, you really have no choice but NVIDIA if you want the highest end AI chips.
You mentioned the airlines a minute ago, and I'm just wondering if they fall into your monopoly bucket here. And even I'm thinking as an airline, even if you have kind of a monopoly that might be granted by a government agency over certain routes, that doesn't mean you're automatically going to print money there. And we've seen the airlines, I think Warren Buffett has regretted many times over the years having dabbled in airlines, but how do they fit into this paradigm?
Oh, they don't. I mean, while certainly you theoretically could have a monopoly where there's just one airline flying from one place to another, if you think about like, say, a JFK to an LAX, tons of airlines flying that route, near perfect price competition. People are willing to switch amongst the airlines. If you have a pandemic or recession, you still have to fly those routes to keep it. So I'd consider an airline or like a restaurant to be almost like the opposite of a monopoly generally.
So what are you looking for in terms of investability in a monopoly space?
So what I'm looking for is a few things. I want companies that have growing returns in terms of both their ROIC, in their return on capital,
very good.
Both in terms of their earnings growth overall, their top line revenue. But what I really want is a company that has phenomenal margins and improving margins where you have no real alternative. And that doesn't have to be a monopoly. It could be an oligopoly. So if you think about like, for example, a Visa or a MasterCard, they're like a perfect example of an oligopoly because you can't really just go out and launch a competitor to Visa or MasterCard. And each incremental user or business using it makes that network more valuable for both sides of the equation. Those are the businesses that I consider to be the thriving monopolies that we're looking to own.
All right. A little bit of a pivot here because on today's Market Show and Tell, we zoom in on operating leverage, which is what a company gets when its big fixed costs are already paid. So each extra dollar of sales or revenue turns into a larger boost to profit. And Uber is a great example, and a name that I know you're looking at, David. It's a clean case study that's gone from a hope and promise story stock to a real business that's generating meaningful free cash flow, which is the cash a company has left over after paying its operating expenses and business investments, or so-called capital expenditures. So a lot of terms there, but zoom out here and tell us about the Uber story and operating leverage, please.
Sure. So when you look at the Uber story, it's both the story of a monopoly in the sense that certainly Uber is far bigger than Lyft. And even if you look at it as an oligopoly, it certainly fits that criteria. the more people you have using the network, the more consumers, the more drivers you have, the more valuable that network becomes. But it's very expensive to build that network in the beginning. You have to get all the drivers to use it. You have to get all the people to start using it for rides. But once you have that defensible network, you have something incredibly valuable that you can extract massive growing free cash flows out of, which is what Uber is doing today now that they've really reached that critical mass and they're continuing to grow with much less marketing expenditure. So it really switched from a cash burner to a massive cash flow growing story, but a growing cash flow story at the same time.
And how do you view some of the monopolies that we were just discussing, Uber as one example here, the relationship to the U.S. economy? We've been talking a lot about the state of the U.S. consumer, how we're on a bit of a two-track economy, a K-shaped economy. What's your view on all of that and how that fits into your investment thesis?
Sure. So you can certainly see how inflation is impacting different parts of the economy and high wage earners versus lower wage earners. So it certainly has been a net win for those who own assets and not a net win for those that are providing labor. And you can certainly see that with like an Uber, where certainly Uber drivers, they can do reasonably well if they're willing to work full time and or even more than full time. But you can also see at the same time what's going on with, say, like an Uber with a Waymo, where if they can replace those drivers with robotics and self-driving, that can propel the earnings or net worth of those people who own Uber stock, but not great for those Uber drivers.
All right, well, we need to take a short break, but coming up, we're tackling jobs and the U.S. economy, as well as a runway showdown pitting the cash rich against the cash hogs. Stay tuned. Well, this episode is brought to you by the number 4.4%. That's the unemployment rate in the U.S., according to the latest data from the BLS. It's the highest since late 2021, but still well below the pre-pandemic average for this century, which was about 5.9%. Now, it is worth noting, because of the government shutdown, some of these figures have been delayed. Bottom line, though, investors are trying to figure out whether the economy is still strong enough to avoid a recession. So, David, what do you think? Are the fundamentals all in play that we are not going to see a recession in 2026?
There's an easy way to game it so you don't have you don't have a recession, and I call that inflation. The real question, I don't think, is are we going to have a recession in the traditional definition of declining GDP? I think that's incredibly unlikely. The real question is, do we have real economic growth? And whenever you have GDP growth that's not higher than the inflation rate, I'd consider that to be a closet recession. So I think it's very possible we'll have a closet recession, but you'll certainly see economic growth most likely in 26 going forward.
All right. So let's game this out. Let's say we have a closet recession. What do you invest in then?
So I think what you want to invest in almost regardless is those companies that do have a combination of high margins, growing revenue, growing earnings, strong moats around those businesses. So firms that fit into that monopoly theme or that growth company theme where they have true dominance and have the ability to grow even through recessions. What you really want is that secular growth, not the cyclical.
And we've seen those mega cap names do really well throughout prior actual recessions before, so I guess that makes sense. What else are you looking at for in 2026? I know we've been talking a lot about these growth stories and everything, but I know you're also looking at aerospace and defense, for instance.
Certainly. So if you look at a company like, let's say, a TransDigm, for example, they have a great version of that moat around their business. Meaning, let's say you make one of the only airline replacement parts for 777 or something of that nature, or for an A380. If you're the only company that makes that replacement part or makes it well, A, you got a monopoly. B, you got a situation where people aren't going to generally want to try to save money on that one key replacement part when it's what keeps an airplane in the air. So I think that's what you're looking for when you're in the aerospace, is you either want the parts, the replacements, or you want those companies that are, truly innovating, like if SpaceX eventually goes public.
And how are you viewing the broadening trade at this point? Again, at the start of the year, healthcare was a big underperformer. Now, over the past month or so, we've seen healthcare emerge as a big gainer, while some of those big tech companies have taken a step back. So do you think that broadening trend will continue into 2026? And is that needed in order to continue to push valuations higher for the stock market as a whole?
So what we're really looking for in healthcare is those layup situations, the companies that are going to do well regardless of what happens with the subsidies to the ACA or things of that nature. That's why we're looking at companies like an MEDP, for example. They're a CRO, or a contract research organization, where they facilitate and make it much more economic for companies to generate new drugs and to facilitate that entire process on their behalf. And the more companies they have where they're being the CRO to that healthcare firm or that biotech firm, the better they do.
I got a big quick picture question here. We're talking a lot about competitive advantage, moats, and also monopolies. Where does that go wrong? When do you not want to be invested in a monopoly? Ever?
Yeah, it's a good question. The time you really don't want to be in a monopoly is when that monopoly starts losing its dominance.
Or when the FTC is going after them, maybe.
Interestingly, I think what you'll find is that sometimes after the FTC starts going after them, that ends up actually being a signal that it's a phenomenal business. Okay. So if you look at like
Alphabet,
Visa, MasterCard, Alphabet, Microsoft, they've all had the regulators going after them, but it's actually been great for their stock because it ends up creating a bit of a moat around their business, or they already have a moat around their business. The key is when there's a technological change that really disrupts that business. So let's say you're an Intel and you had the best Pentium chips out there, but now there's a new generation that's coming along that's far better than their pre-existing chips. That's when you don't want to be in a monopoly, is when you start to see that they've passed that tipping point and they start losing share.
I got a question here. When I think you also manage some funds or give some investment advice based on insider holdings. And I've always seen that as kind of a murky area. I've tried to see if I could find some alpha in those signals before. I'm wondering how you find any alpha in there.
Yeah, so we have this fund called the Catalyst Insider Buying Fund. And what we focus on there is companies that have heavy insider buying by their top executives and or heavy insider ownership by those top executives, especially if they were founders of that firm. That's a theme of stocks where we've historically seen great performance, where people are really running the business fully aligned with shareholders. Now, the issue with insider buying and insider selling activity, like you pointed out, is it's a murky area. A lot of the data is irrelevant. If you see insider selling at a company where, let's say, it's
pre-programmed.
Yeah, and you see that situation where if I owned over $100 billion of Google stock and I co-founded Google, no matter how great of a buy I thought it was, I'd probably be offloading some.
Yeah.
If you see a situation where a new director buys $1 million worth of stock, that doesn't necessarily mean anything if they're required to own $1 million worth of stock as a director of that company. So that's really what you have to do, is you have to find either the points where there's a tipping point where it flips from insider selling to insider buying, or insider buying to insider selling, where you can see there's something clear and significant going on, or if there's several executives buying more stock out of their own pocket, not just stock option exercises, and that coincides with a business that's doing well.
I'll have to take a look at that again. So some excellent advice there. We got to make a hard pivot because we have got a markets take on a classic Hollywood gab show staple, Who Wore It Better? Today's Runway Showdown is all about how you power profits. On the left catwalk, we've got the cash flow platform, strutting in a sleek, minimalist look. It lives in the app, takes a cut of every transaction, and leans on operating leverage so that more of each dollar can drop into the bottom line. On the other catwalk, we've got the capital hog, draped in heavy hardware and fixed costs, planes, buildings, big equipment. It's a great outfit when demand is strong, but tougher to pull off when the business cycle turns. So, David, which style would you rather own in your portfolio given the current market environment, the light cash flow platform or the heavy capital-hungry hog?
Well, I think you'll know what I'm looking for.
Yes.
I'm always looking for the capital efficient one that can grind out profits, generate an incredibly high return on capital for each incremental dollar that goes into that business. Those historically have been some of the best businesses out there. If you think about all the biggest success stories, whether it be an Apple, a Microsoft, an Nvidia, Visa, or MasterCard, they've really all fit that capital light bill.
What are your thoughts on the circular investment cycle of AI when we talk about capital expenditures and we talk about investments? Is that at all a concern to you?
Everyone investing in each other.
And we've heard more signs that they're taking on debt too.
Right. I mean, I think if you look at OpenAI in particular, if that were a publicly traded company, I'd say sure, that could be a bit of an issue as to how they should be valued. But when you look at an Nvidia, they have such a tremendous, significant backlog and so few alternatives to their chips, and their chips are so much better than the next alternative that I think it just really helps propel their cash flow. But you should probably apply some discount to those companies that they're investing in that are then using that cash to buy even more NVIDIA chips.
Power of the monopoly.
Yes.
There you go.
One of the things that we like to talk about here is risk management. So put aside everything we've talked about so far, just some basic risk management strategies or something that, whatever comes to your mind so that people can help manage their positions and maybe get into a trade a little bit smarter and out too.
Yeah, so I think there's a couple things you really need to look for when you're doing risk management, when you're building out a portfolio. And I think the most important thing is the durability of that cash flow or the durability of that earnings growth or the persistence of it. Because if you have a company and that company, if we run into a recession, is going to take a significant hit, that company is not nearly as valuable long-term as a company that can power right through. So for example, if you think about a company in the healthcare space that has a key drug or that has a great relationship in terms of the way that their health insurance is provided to employers, those companies that have that durability of cash flow and the persistent secular growth in their cash flow, whether it be like healthcare or like in the technology space, if you look at cybersecurity, nobody's going to stop paying for healthcare, stop paying for cybersecurity, even in the face of a recession. So that's the way that I like to think about risk management is if something really hits the fan, is my company hitting the fan or can it power right through?
All right. We got 30 seconds here. Any final words for investors?
Well, I think the other thing that investors need to be careful about now is not necessarily actually valuations. Valuations for the largest companies, I think, are very well justified because these tend to be wonderful businesses with many of those factors that we talked about that have great margins or monopolistic or oligopolistic characteristics or network effects via operating leverage. What you really need to be careful with is your fixed income book. Because in your fixed income book, if you have a situation where we have a $38 trillion plus debt and a $1.8 to $1.9 trillion deficit, you need to do something so you can have some proper inflation protection because, you look at the last decade, we've had 5% inflation in healthcare, housing costs, and education, but the bond ag's only done about 1.8% annualized. Bonds can actually be pretty risky, not necessarily from more from a purchasing power perspective than a loss of principal, but a dollar today is worth about the same as 12 cents was in the 1970s. So I think that's a key risk people really need to think about is maintaining their purchasing power even more so than their principal.
David, that sounds like an entirely different conversation we'd like to have someday with you. Thank you for joining us here today. And just a quick recap, we talked a lot about monopoly. I'm going to go look into the board game again. And of course, some of this is tongue-in-cheek in as much as competitive business practices infringe on the rights of other businesses. We're not trying to promote that here, but there's a lot to contemplate when it comes to assessing those competitive advantages and how they might play out in the markets to begin with. So we've got to wind things down, but be sure to check out our other episodes, and we will see you next time on Stocks in Translation.